All right. Good morning, everybody. So we're risk on green mostly around the world. Hong Kong is still down more than 0.75%, but other than Hong Kong, things aren't looking too bad out there. The UK has got some economic data with Christine Lagarde going to be coming out at 8:30. She's the biggest thing on the table today. Now we get past her. If you don't really understand her role, she would be like the European version of Powell. It's not a perfect correlation, but that's what we would put her in. So you can imagine if Powell was coming out, going to be chipping teeth this morning. Well, for our afternoon, because in London right now it's 12:30. So, kind of consider it like that, right? So Europe's flat, waiting on her. That makes sense. If we were waiting on Powell, we wouldn't really be doing much of anything either. We'd be chopping about sideways. Japan is slightly green. So if you remember yesterday when I mentioned that Japan was going to have data and it was something to be watching for, they're up a little bit. And then that gets us into the US with the Dow down or up the least and small caps up the most with more than 0.75%, followed by the NASDAQ at 0.75%. So it's looking pretty good out there. And it all started with that flip yesterday in the bonds, right? So we do got PMI services this morning, or flash US services PMI. We've also got some additional auctions today, and that's going to be a really big deal. Later in the week, job numbers are coming up. And while the Fed has said, that they're not deliberately trying to cause a lot of unemployment, they have also stated that a sign that they're accomplishing their goal is going to be seeing unemployment. So, it's kind of a catch-22. They're not trying to cause unemployment, but they'll know that they're doing a good job and getting to their goalposts when they do see unemployment. And that means when we get employment numbers, it's something that we want to pay particular attention to because it's what the market is going to be paying particular attention to. They're in this spot where they're trying to find mildly restrictive territory, which means you first get to neutral rates and then you go slightly beyond that. But it's a mythical thing, right? It's like trying to capture the unicorn or the end of the rainbow. What is neutral rates? And then how far past neutral rates is mildly restrictive territory? We don't have an answer to that, right? But that's what they're working on. So they've hiked to this location. They're sitting and waiting, watching the data to see if this is mildly restrictive, if it's restrictive enough, or if they've already moved too far, too fast, and if they're breaking things. And these numbers that are coming out are going to help them answer that question, which means they're really important numbers, right? So today, yeah, we got some data. Throughout the week this week into Thursday, when we start getting these unemployment numbers, that's bigger data. That's more important information. And it's a game changer on the entire of marketplace globally. So, just kind of keep that in mind if you're looking at this move and thinking, oh yeah, baby, we're running back to the top now. Yeah, easy. Easy. Christine Lagarde today, 8:30. The global manufacturing PMI 945. The Richmond index, I'm not going to say it's not important, but compared to what it's surrounded with today, it's not as big of a deal. And then the 2-year auction at 1 o'clock. That's a pretty full house today. We do have Google and Microsoft today at 4 o'clock as well. That's some big hitters. And remember, it's not just the numbers that they put out. It's the discussion afterwards when they come out talking about their forward outlook on supply chains, the global economy, their ability to make money. That's going to be key. And it can also rip the world right in half or run us to the upside. So worth taking a listen to. I've been trying to encourage people to use AI. I use AI all the time to digest information faster. I just feed it a news article and it'll condense it about 90%, 80%, which means I can absorb a lot of information really fast. Earnings are boring things to read, right? It just sucks. But feed that earnings report to AI, let it digest it for you, and then get your information out of it. And if you don't know how to do that, put that on your to-do list today, is to learn how to use AI to do that. You got a lot of choices: Bing, Bard, ChatGPT, whatever, right? I use a program called Upward. It's not free, so it's kind of recommended, use something else first until you get more comfortable with AI. There was some discussions yesterday about the move that we had, and I thought it would be worth taking a look at, a couple of things to kind of get a better idea of what was happening yesterday and how we could have perhaps validated that a little bit sooner, that move that we had. Now, a lot of us were already looking for, a gap down rally Monday. It's why I like gaps down on a Monday. It was a key level. It was right at the 50. We saw that defense. It came in beautifully, ran it back up. Now, it had a hard time keeping most of the run, sure. But if you looked at the options yesterday, they were really signaling a lot of bullish bias through the morning session. All these big bubbles were big premium orders in options. And the 422 strike was getting lit even by 10 o'clock in the morning. And you can see how much everybody was targeting the 422. And if you think about where SPY was when we opened it yesterday, and how quickly we went towards that 422. So it's just optionality tools. These things alone wouldn't be enough, right? They're just one piece of the puzzle. We opened at 420, dropped down to 418. Then we started moving up towards that 422 because that was the option strike that was mostly getting hit yesterday. And they monetized it beautifully. You see the GEX magnet 425. That was the second one after the 422, 423. Yeah. Good times. Bitcoin is up over 9.75% this morning. Wow, right? Just, yeah. You like it. This is a really nice basing pattern. I'm on a daily chart. We've been doing like the Wyckoff thing, right? Distribution, massive basing pattern, and now accumulation. Not in a straight shot, but 47 is on the table. Gotta like that. US dollar Japan continues to hold right around that 150 level. So we continue to sit with this threat. If we look at US dollars, Japan's 10-year, we can see how we came off a little bit, and that removed some of that threat, just a little bit. But we have rallied back up off of that low. So we got the gap closed, but we rallied back up. We're back inside the previous day's range, and we're still threatening that 0.86 area. So we'll bring that on up. Maybe give ourselves a 50% level here. Yeah, 0.861. So we really want to see signs that this is going to hold these lows, and not getting back above that 50% mark could be a good start. $9:45, 10 o'clock, 11, 1, and then later tonight we've got a CPI from Australia. Not going to say that that doesn't matter, but that one don't matter. I didn't say that. Volume's looking normal this morning. We're sitting in the 130 range. This is fine. This is normal. I'd say it's even a little heavy considering that we do have Christine Lagarde on deck. All right. If we were looking for them to sit out a little bit, maybe to hedge against something that she's going to be talking about, we're not seeing it here. There's kind of two ways to look at that they're not worried about what she has to say, or they think what she has to say is going to be positive. This isn't the kind of flows that would tell us that they're sitting out, and they're certainly not trading into it. Earlier in the month, we were seeing, 170s, 180s. So they were certainly trading into that data. They're not trading into this. So this is just normal. 130 something is fine. What I tell people, is have this kind of benchmark idea, this staple of what it should be. And if you come in every day and it's at that level, then you're good. There's nothing to worry about. But if you come in and it is at the extremes, or it's really low, then you're going to want to know what's going on. Preferably checking the news first for any economic data and blah, blah, blah. This orange line here, I added it this morning because I don't normally have the 50-week on my intraday chart, but that 50-week is what we're interacting with. We did it yesterday. We're doing it right now as I'm speaking. It's the 50-period moving average from the weekly time period. All right, so we come out here on the weekly. It's this moving average that we're hitting. We also hit it last week. We hit it a couple weeks ago. And there's the lower 50-period moving average. Both of those orange lines are 50. This is to solve the problem for all the people who say, oh, is that the EMA or the SMA? It doesn't matter. I promise you, it doesn't matter. So if you're in doubt and you're just not sure which one to use both. I've got both 50s, both 20s, both 10s, both 200s, and I'm telling you, it doesn't matter. But if you put them both on there, you'll see, what did we hit yesterday along those lows of the week? We hit the 50. What are we hitting now this morning as we're trying to rally back up off of those lows? We're hitting the 50. Oh, wait, it's a different 50. Who cares? It doesn't matter. Half of all traders use an EMA and half of all traders use an SMA. So we may as well look at both to see what both sides are seeing. It does make for a cluttered, nasty mess. 4211 is the cog line. It's also the 50-period moving average. We didn't exactly hit it right on a button yesterday, but we got darn close to it. 4200 is the put wall, and it was rolled up yesterday. So it was brought up from 4200. It's now 4224. That ought to say something, right? When we were continuing to move to the downside, they kept rolling that call wall down, bringing it a little closer and a little closer, a little closer. Now we had this really nice change in market structure yesterday, and they rolled the put wall up, brought it right up underneath the market. Why? Now remember, we're in a new options regime, right? The third Friday of the month is options expiration. We're in a new options expiry month now. Maybe that has a little bit to do with the roll, but yesterday it was still at 4200, and this morning it's at 4240. 4224. Ah. Another little touch on the move that we had yesterday. You can see KRE, which is regional banks, opened, and they kind of hovered for the first 30 minutes, just chopping about near their open and staying within that 5-minute range. Then they expanded nicely and then kind of stalled out, stayed above VWAP through most of the day, got back down below it after 2 o'clock. And it was not right on the dot 2 o'clock, but a little after 2 when we started getting those heavier flows and we managed to break down through it. So finance directly affects the S&P, not the NASDAQ 100, because the NASDAQ 100 doesn't have financials in it. But if you look at NY Fang yesterday, that V-shaped gap down flip, we got right back to the RTH open and then just a steady march above it, farther away from it, all the way up into 1 o'clock and then topped out. So, these two sectors, the financial sector and technology sector, are 2 of the 3 risk on sectors. Consumer discretionary is the 3rd. And if you didn't see that crazy move in Tesla yesterday from 202.5 all the way up, then you'll understand that consumer discretionary, which is where Tesla is at, also was a part of this risk on sentiment drive yesterday. All the pieces were there. As for how far it goes, most of the time we make a measured move, and that's as far as we go, right? We just make the measured move. These red lines are the ADR half of yesterday. They are measured from where we open. It's what I talk about in the morning briefing every time. It's the ADR half and then the ADR full. We went to the ADR half and overshot it a little bit. And then we ran back towards the other side. It's not a perfect science, but generally speaking, we tend to go to that level and stop there or stay there quite a bit because it's the average daily move. It's what we do on a day-to-day basis. That's how it became the average. So, when you're looking at a market on a day-to-day basis, what do you expect it to do? The same thing that it has been doing for the past 20 days. Only if it does something unique and different does it stand out and we say, oh, well, that was so different. Look at what we did today that was different than the norm. We don't have an MDP. We're resting on that pivot point, hit it a couple times. We are back inside of the previous week's price action. So that's a good start. But now there are levels that we have to deal with all the way back up. If we measure last week's range, then 43.33 is the 50% mark. It's that line in the sand, that level that we have to get past. I didn't see that question when you asked it, and so I'm not quite sure what you're asking. 10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. Now, this is a phrase that's been around for a while, and it's a part of the snapshot that I try to get people to understand when it comes to using a multiple day time frame concept like this. When you're applying a volume profile on a day-to-day basis, or even just using yesterday's profile in today's market, that phrase doesn't fit, right? That's just a whole different approach to a volume profile. On this 10-day profile, what I've been trying to encourage people to do is to understand that when we were at these highs, that wasn't the high of the profile, right? We didn't run up and hit this high and then fall back off of it, because at the time, that wasn't the high. There was higher price action to the left of this, and that was like mid-range, right? So if you take a picture of the profile every day, say at 730. After about a month, you can go back and look at those and you'll realize this concept that we didn't run up and hit that high and then fall down. We didn't hit this low that was a low, right? With this time, we actually set a low and now it is the low, but we didn't go down and hit something and bounce off of it. And right. And this is a difficult concept to grasp, because when we do look at it sitting here, it really does look like price ran up and hit that top and fell away from it. And it really looks like price fell down and hit this low and bounced off of it. But price made that low. It didn't hit that low. And this wasn't the high at the time. There was higher price to the left. In fact, when we made this print, it was kind of like how we made this one. Price came down, it set that high, and it continued to fall. Well, after days go by and that price is no longer here, and this happens to be the high of the profile, it's going to look just like that. And it's going to look like we ran up and hit the high and we fell away from it when we didn't, right? So I use that phrase, when we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We do expect price to work back towards this high. But this high is going to come down as we lose more of this price to the left. Okay. It takes some time to get used to this multiple time frame volume profile. Yeah, when it comes to moving the put wall, it's mostly about those big institutions that go in there and collar, right? And you can usually see the strikes. So we got the November 14. That seems a little early. 1, 2, 3. It should have been the 17th. There it is, the AM settlement. So we would look at this and we would look for that wall to get rolled. See that really large open interest right there? Hey, we found them. They rolled out of those 4200s and they rolled it up 42.25. And it looks like they're not done yet. They were at 4,900 and they only got 2,900 here. So maybe they'll do it in batches. But if you see this spot too, maybe they spread it out a little bit and they're already working on a 4250 put wall. I don't like to hypothesize too much. I don't know what they're doing, but we're able to find them. So with this, we do have an air pocket. If we can get above, say, 4280, then we should be able to move through 4300 relatively easy. There's a little speed bump here, but it's not much. And we should be able to get up into, say, the 4350s, even into the 4380s, relatively easy. This is a very large TRB, and we're already starting the breakover. Remember that when you're drawing the line, it doesn't matter, right? Don't stress out on, should I use the wicks? Should I use the body? Can I use both? Oh, it cut through right here. Does it matter? It's just a visual, right? To help you see it better. That line isn't going to change what price does even a little bit. So you can draw the line, or you can just imagine that the line is there. This is the TRB. We've built our base down here. We're getting our higher lows. We just don't have that higher high yet. So, you know, we're starting the turn here for that move back up, but we are dealing with this price shelf right here. So we've got this to deal with. But if we can cut through this high 4280, then we should be on our way, right? And it's not going to be a straight shot. I'm not talking about getting back up there in a single day. So that VPOC from Friday, we did cut through it yesterday, and we're going to take it off now, but I want to show why we keep that on there. So when price was making that ramp up yesterday, it stopped at that VPOC. Now we don't consider it a support level, resistance levels. It's not that kind of tool. But when we do get there, we expect to see if there's any unfinished business left. That was the most heavily traded spot on Friday. And it makes sense that if you go back to the spot where most people were doing trading, that there's still people who wants to get more trading done there. And that's what we saw. It immediately had a reaction at that level. So if I was looking to trade a long, right, after we had this move up and it's paused here for a moment, it looked like it was going to break out and go. And yet, you know that line's there. You don't try to buy that breakout because you already understand, hey, there's only like a 2-point move here and you're going to take a rejection. Might be better off to see if we even reject there at all. Maybe we punch right through it. Then I can try to find a trade. And you can see that it held for a while. There was a lot of work that still needed to be done there. There was still traders that were interested in getting that done. And then once it was done, it's a fantastic outcome, right? Blow off top. And then down we went. That's a capitulation move, right? The last hurrah, blow off top. So VPOC level, they're worth putting on the chart and keeping an eye on, but they do get dated, right? We've seen ones that I've had on the charts for months and months. And when we finally get back down to them or back up to them, that we just run right through it like it wasn't even there, because they're very stale, they're very old. And when it comes to the futures, they date, right? If these were marked in September and we're now using the December series contracts, well, there's no unfinished business left. We're not even in those September series anymore. So this lower one, for an example, we cut right through it yesterday. And of course, we're taking it off today, but there's just nothing there, right? And there wasn't anything there. No unfinished business, no expectations of any work to be done. So for Monday, we have cut through the VPOC. If I was to have drawn it, we would have hit it this morning at around 6 o'clock. And it's right at this yellow line. So we can already see what happened with price. It ran right up to that VPOC and it stalled there, struggling to get through that level. Pulled back, tried it again, and still struggled to get through that level until finally all of the trading at that level was done. There was nothing left to be traded there. And anybody who wanted something had to reach for it. And we finally started to move up. So those VPOC levels have some value to them, right? They're some overhead at 43.32, 43.70-ish, 43.69, something like that. And we got these older ones down here, but these are the ones that I'll argue that, you know, they may not have much value to them. We're not using those contracts anymore. But what if it was Apple or, you know, Microsoft, something like that, something that didn't expire? Because if you've got shares of stock, I mean, you know, there's no expiration to that. So VPOC, depending on what you're using it on and where you're using it, it could still have some value to it. But the ES, for an example, or the NASDAQ futures, those contracts are dated, you know, and then we don't have them anymore. They're gone. So I don't know how much value they're going to have when they're that old, but we'll keep them down there anyways. All right, so we can't see it in the ES, but let's just swap over to the SPX for a moment, because this move yesterday is a classic move. It's one of the things I love about a Monday, and there's not there's not much about a Monday that I like. All right, so we at least have this, right? It's this 3-bar move to the downside and then a gapped down start of the week, and we drop lower just enough to really get those bears interested. And this one is even better because it was a micro double bottom, but it doesn't have to be. It could have just been a 3-bar move to the downside and then a gap. But a beautiful micro double bottom, 3-bar downside day. We gap, we drop just a little bit lower, and then we ripped to the upside. Textbook perfect day. The only thing that was a little off about all of this is that we didn't keep it, and normally we would have kept it. So 50% of the previous day is always a level to keep your eye on. We even overshot that, right? So we went down and came back through our own open, through the previous day's close, through the 50% mark. It should have kept all of that. And instead, we fell back down. And how we closed yesterday is really important. We closed below Friday's close. That's a negative. We closed lower than 50% of our own day. That's a negative. So I'm not overly excited about this gap recovery and move up from yesterday. I'm kind of thinking that maybe we're not done going down here yet. And I am ready for an upside move, baby. Trust me, I'm all over it. But this isn't good. If we were going to gap up and go and have this really great run back up to the TRB high here across this 4370, then it should not have closed so weakly down here. Think about this wedge setup that we had back here and that gap down move where we opened way down here, kind of touched the edge of the weekly expected move, and we rallied in the single day all the way out of this IX10 box, all the way past the previous week's close. And sure, we faded off a little bit on the day, but we closed in the upper portion of that candle. We kept the move, and over the next few days, we finished the run back up to the previous level, right? That's the cup and handle. What did we get this time? A dud. It's broken. This isn't what we want, right? It's like when we closed there and we opened here, had that little recovery, but it wasn't enough. Okay, so this isn't what we wanted. It's not the droids you're looking for. Nerd. There is a gap overhead still, 42.78, that needs to be resolved at some point, but that's not the focus right now. The focus is dealing with this shape, right? So let's take it back to the ES. We have the same shape, and we can see how we're sitting inside of yesterday's range. The S&P, of course, the SPX doesn't have anything showing, and so there is no bar here to even look at, right? That's why we come back to the ES. That's why I do my morning briefing on the ES. We need to resolve yesterday's range. We need to keep that 50% mark now that we're back above it. It's going to be a really good start. Get back to the high of yesterday and break that out. And we'll start working on things one level at a time, all the way up through this zone. We're still looking for these highs. This is just not a really good start to that kind of move. And what we could get instead is more of that IX10. So inside day would be us just sitting here for one day. This day stays inside of yesterday. We close, and then say tomorrow we open and run. That would be just an inside day breakout. But if we stay inside this zone today, and then tomorrow, and then another day, well, now it's IX10. And the longer we stay compressed inside that day after day after day, the more compression, the bigger the move. Now, it's not overly exciting when your inside day happens to be inside of a very large, wide range, because then it's not implying any kind of compression at all. It makes sense if we have a really wide day that we happen to stay inside of it for a long time. So we'll round this down to 42.10. We got 42.80. That's a 70-point range. That's a pretty wide range. Staying inside of a 70-point range isn't going to be that difficult. We still need to get out of it. So that's going to be the goalpost right now, is getting outside of yesterday's range and staying above that 42.47, the 50% mark. We've reclaimed it. We need to keep it. We're 2% below the 10-week. And, you know, we've been lower than that. We were closer to 3 than 2. And now, you know, we're kind of making that curve back up. Keep in mind, as choppy and nasty as this is, it is a bit like a wave, right? So we swung down, came back up. We swung up through and came back down. We're on the swing back up now. Doesn't have to be a straight shot. We can be working our way back up and still drop away from it. We've seen it before, but it's a good start. We're moving in the right direction with this wave back towards the 10-week. Took a look at it on the daily, same thing. We're on our swing back up. We're around 1% away from the 10-day moving average. The thing about the spot gamma levels, by the way, even if you don't have a spot gamma account, you can go to YouTube and you can search for whatever level that you're looking at. It can be, the zero gamma volatility level, the call wall, the put wall, and they've got some good YouTube videos that explain what it is, because obviously, they want you to buy their product. And so they explain it to people, even if you don't have their product yet, because of course they want they want your business, right? So the cool thing is, though, is that you can go to those YouTube videos and watch them, and then still I show them every day, right? I show those levels so that if you now understand what they're good for, you don't necessarily have to buy their product. You can just watch my morning briefing and you can still get the levels. Bonus for you. We're going to tighten this up to year to date. It's normally where I have it set anyways. And the reason I'm doing that is there's this white line on my screen that goes from the left to the right. And that's a linreg line, linear regression. It's set to this year of date. So starting at January 3rd of this year to where we're at now, the mean or the middle or the average of all of this price action is that white line. But that slope of the line shows the progression through the year, the aggressive move that we've had this year. And we're still up in the S&P 7% on the year. So while we were at 18% and we've sold off significantly from that, we're still up 7% on the year. This greatly reduces that performance chasing that I had been talking about earlier in the year. The idea that we were likely to see a lot of very aggressive late quarter action by fund managers who are going to have to explain to their clients how they couldn't beat the S&P. But now we've seen this drastic pullback from that 18%. This will greatly reduce that performance chasing insight that we were looking for. So it's worth keeping an eye on that. All right, we got Bitcoin and then Bitcoin related products. That'll be HUT, Hive, Mara, Coin, MSTR, all of those things, right? Behind that, we've got Nat Gas, the FANGs, communications, semiconductors. You remember yesterday we were talking about how semiconductors were the thing that was down the most. By noon, they were the thing that was up the most. They were just getting it to the upside yesterday. It was one more tell on that drive that we had off of the lows, right? It's like it was a rising tide scenario, sure, but it was in targeted technology names that really carried that lift really fast. And gold and precious metals are down this morning. So in the top 20 names of the NASDAQ, which is a list that I tend to keep my eye on, Tesla's up the most, Nvidia second, Meta third, and then Amazon, PayPal, AMD, Google. Literally, that's all of the FANGs in a row right there. The FANGs are the dominant driver this morning. Now, I do have IWM tucked into this list. Obviously, that's not a part of the NASDAQ top 20. And, you know, we scroll down, I've got the NASDAQ and the SPX and the Dow Jones in there. That's just to save me from, you know, having to look somewhere else to get that same information. Otherwise, the top 20 names in the NASDAQ kind of gives you an idea, right? It's like a more generic FANG list, but a broader list. It's got, you know, more stuff in it, like Pepsi and Costco and T-Mobile. So I'm not so blind. But if our benchmark is 0.5%, it stops at the FANGs. Like we don't have anything up this morning in the NASDAQ 100 more than 0.5% that isn't one of the FANGs. So crude is still chopping about. We got nothing here. We're back below the 50% mark, but we're still holding inside of that really broad day. Gold, after that really great run that it had, this is drop base rally setup, textbook, picture perfect. It's one literally for the calendars. So really great move here. Stalled out a little bit across the highs as we could expect. I mean, all of this wick, all of this showing that they were really heavily defending this level. And sure, there was a strong drive that got us through there and we actually closed above it. But like I've mentioned before, just because we passed through that kind of a zone and we managed to close on the other side of it doesn't necessarily mean that we've taken all of that liquidity away. Because a lot of times, and it would make sense too, if you're the one selling it and you see that there's a heavy demand, aren't you going to try to sell it for a little bit more? Why not, right? Why sell it at 1980 if I can sell it at 2000? So if we cut through that zone and then we fall back down below it, we could very likely still see a lot more selling there when we come back up into that zone again. I don't know if they're done yet. That's why we watch order flow to see if there's still heavy trading at that level, right? So just driving through it isn't enough. We know it's still a key zone. We don't know if that key zone is done. And even if we do get through it, we've still got all of this back here to deal with, right? Above 2020. So a lot of work still on gold, but that was a great move so far. The question is, can it keep it? And if we just measure the whole range, we're still above 50%. And that's kind of the line in the sand that it needs to keep. This was a long TRB. So we kind of got the breakout. Now it needs to follow through. And that would be getting up into that 2045, 2050 area. Nat gas is up this morning at just a little bit. We've marked this out last week and I talked about the 50% mark. Well, dun, da, 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 we found it. Needs to keep it. Kind of bring it in on a daily a little bit. We can see how we're digesting around that 50% mark. We're trying to work our way out. But if we were to put a Linreg bar on there, you can see how the swing from the high to the low, back to the high to the low, we're back to the high. We would have to do a little something out of the ordinary here to break that swing. Wouldn't surprise me if we digest a little bit more, change the slope of this just a little bit more before we try that breakout. But either way, it's still keeping that 3.07 breakout, and it held the 50% like it's supposed to, like it needs to. So this move out isn't squashed yet. It would have been invalidated if we'd have broke that 50%, but we didn't break it, so it's not invalid. We could continue to make this move to the upside. If you're concerned or worried, you're going to want to wait for the breakout now above this level up here. If we were using IBD's investors business dailies entry parameters, they would call it an early entry on a trend line breakover. So, you can consider that. Breaking over that line would be your early entry. Either way. Inside day on silver. Inside day on gold. But look how much weaker silver looked. And that's a little odd because silver had been dominant, right? When it comes to precious metals, silver was kicking it. And now, it's down pretty good on the day. And look how it's sitting in that candle. So I'd say the range or the zone is well defined here. As opposed to gold, which looks a little different than that. Both of these being down, very likely because US dollar Japan is making that move to the upside. If this gets rejected and we fall back in US dollar Japan, we're likely to see gold and silver at least get back up to yesterday's close or this week's close. Those are weekly candles, so put that on the daily. We want to at least see how gold is or silver is gapped down so much. We want to at least get back into yesterday's bar. So watching US dollar Japan, we take that rejection off of the high. You see that fall. You got a rally in silver at least back up into yesterday's price. Now, yesterday when we had the dollar and the 10-year falling to the downside and we had that move up in the S&P, that worked out relatively well, right? We see that fall, we can see that rally. Well, today we've got the ES just kind of grinding higher, and we've got the Dixie heading higher too. Right, so this is a little bit of that disconnect, right? It's why looking at both of these on a tick by tick or candle by candle move, with the dollar moving up, we expect the ES to go down, or the dollar going down, we expect the ES to go up, and that's just not what we're seeing tick by tick, right? So look at it instead by where are we at in that. Well, the Dixie's still below 106. That was kind of our level that it needed to get below if we were going to see a little bit of a bullish bias in the markets. We're still below that 106. We're still kind of seeing that little bit of bullish move in the market, but we're getting close to 106, and we're seeing how the S&P is really struggling to kind of keep this move off of the lows of the Globex session. So, watch for that 106 rejection. Watch for us to get back inside that 106, because if we do get back above it, we're very likely going to see that continued weakness in the S&P. We're not saying it's just going to smack us down and we're going to sell off and we're headed to the downside. It'll just be much harder for the S&P to rally if the dollar is also going up, right? And or if the dollar is above that 106. Same thing with the 10-year. We don't want to see this thing moving to the upside, and we've seen both of these moving to the upside today, and the S&P also moving to the upside. That just really screws everything up, right? We got US dollar Japan going up, 10-year going up, dollar going up, S&P going up. Wait, what? Right? That's the confusion there. And yet we've got bonds going down. everything else is going up, bonds are going down. So the one thing that we want to watch this morning for our tell is the bonds. Sure, I'm never going to say don't look at the dollar, don't look at the 10-year. I'm not going to say that. I'd never say that. But all eyes are on the bonds. Everybody have a good day. Be careful, be safe.